All right. Welcome. Oh dear. So when I was starting out in magazines in the late 80s, some of the best journalism was business journalism. And books like Connie Brooks' The Predator's Ball about Mike Milken and Drexel Burnham Lambert, Brian Burroughs' Barbarians at the Gate about the KKR takeover of RJR Nabisco, and Jim Stewart's Den of Thieves, which was about insider trading on Wall Street. These books all set a very high standard for rigorous reporting and fantastic storytelling. 30 years later, Gretchen Morgenson and Joshua Rosner's These Are the Plunderers, How Private Equity Runs and Wrecks America, fills out and very much continues this tradition. It tells what may be the end of the story through a new set of characters. And one way to read this book is really, it's kind of an intellectual history of private equity. And what's more, it's just a great read. As they write, more than 30 years later, the effect of what began as the leveraged buyout boom in the late 80s, paired with the belief that markets and deregulation support society, are devastatingly clear. So I'll just give a few brief notes about the book before we start the discussion. So what is private equity? Private equity is the leveraged buyout boom that began in the 80s of pooled investment partnerships that take out debt to purchase troubled companies, loot their assets, cut expenses. And this procedure often leaves an acquisition in bankruptcy or in ruin. But the private equity folks themselves are very careful to make their own money back up front by paying themselves well and charging all sorts of fees, sometimes in perpetuity. And they engage in all sorts of self-dealing to the point of even selling, in this book, a company held by one of their funds to another one of their funds for a profit. And what's the result? As the book tells us, these companies that are absorbed by private equity have worse outcomes for everyone except the financiers. One of the ways they cut costs is by firing people. And between 2003 and 2020, retailers owned by private equity lost 500,000 jobs. They charged enormous fees to retirees and to pension funds. A 2020 study found that such fees depleted some funds' returns by 10%. Their companies are 10 times more likely to go bankrupt. And in fact, 15% of all private equity buyouts end in bankruptcy. And when things do go wrong, the portfolio company, the company that they've purchased, not the private equity firm, takes the hit. The private equity ties are concealed under complex ownership structures designed to shield the firms from liabilities. So we all go to doctors and hospitals and have insurance policies that are actually in companies owned by private equity, and probably we never know that. The most devastating part of the book has to do with the healthcare industry. After buyouts of hospitals and insurance companies, patients are more likely to have higher healthcare costs. Patients make more visits to emergency rooms, where they receive more unnecessary procedures, and where Medicare costs soar, so we all end up paying. And residents of nursing homes are more likely to die. So these are very real material impact. And who are these people? The book is, as again, a great read, has these outsized, fascinating characters. Main characters are people like Leon Black, the founder of Apollo, Blackstone's Stephen Schwarzman, who owned $1.1 billion in 2021, the Carlyle Group, KKR, which is run by Henry Kravis and George Roberts. So you get this wonderful world. They create this wonderful world, the portrait of a terrible world in which these people are running around, taking over companies, loading them up with debt, cutting costs, and firing people, and then reselling them or otherwise bankrupting them. So what I want to ask you is, as you note that this is a movement that sort of had its origins 30 years ago in the buyout boom and junk bond boom, what inspired you to write the book now?
Well, we felt after COVID landed and was so devastating across the country that it was really exposing what had gone on for the past 30 years. I mean, it was a really crystallized moment in time where we could see what these people were earning. We could see how they were manipulating the system. We had academic research that had actually gone back in a longitudinal way and could study what the results were. And so COVID kind of crystallized it, right, Josh? Yeah. But it was also, we had more material. We knew what some of the outcomes were.
Yeah, and actually, I think to add to that, I remember us sitting there on the phone during the COVID era, remembering, one, that there was a lot of debt that was actually at risk of having to deleverage, a lot of assets that were at risk. And we were watching as the government was trying to set up programs to protect the public, PPP, special Fed programs, that here these firms were right at the government trough with lobbyists leading the charge, trying to explain that they were systemically important and needed access to the Fed, and for the Fed to start protecting their assets, buying their assets. And I think that was one of the moments where Gretchen and I sort of had this is really, you know, we've come to this Charles Dickens moment. So I think that was a big piece of it. The other piece was, you know, we kept hearing about the shortages of ventilators, the shortages of hospital beds, and nobody was talking about the fact that those shortages were largely driven by the industry.
By private equity, who had been buying up healthcare businesses for years and really eviscerating them. And it was very kind of paradoxical, but there was actually a study back in, I think it was 2005 or 6, by Congress about what might happen if there ever were a, you know, like 1918 flu epidemic. And we, of course, lived through that. But what was said was, well, we would need to beef up our hospitals. We would need to invest in ventilators. We would need to invest in all kinds of things. But what actually happened, Bob, was the depletion of these assets by people who were sucking the profits and the earnings, the assets right out of them.
I mean, the book was so wonderful for really answering some of those questions that I had too. How did we get to this state? Was it just natural unpreparedness? But no, of course, there's a system behind it, which had been systematically sort of cutting back on all the things we didn't need, like ventilators and extra rooms and emergency rooms, things like that, which of course, in normal times, perhaps you don't need, but hospitals are supposed to be prepared for abnormal times, but the bottom line doesn't allow that. But it also, the book also really gave a great understanding, used a lens of private equity to look at that thing that we all experienced of this incredible sort of divide during COVID, where, you know, upper middle class people with lots of stocks found their holdings going up and up and up, and people who actually had to show up at work every day and had to be exposed to that were being, you know, dying or having terrible illness and poverty. And you really sort of see some of the workings behind it through this book, as the explanatory power is pretty great. Why is, you focus a lot on healthcare, and obviously COVID being sort of part of the inspiration for this book. Why was healthcare such a popular target for private equity in the first place?
Well, it's 17% of gross domestic product.
17%?
Yes, in this country. And so it's a very, very rich vein to mine for these people. And also you have government programs that are kind of standing there ready to be milked, waiting to be milked, you know, or manipulated. So it was a very juicy, big target. And the interesting thing, as you always point out, is healthcare system, should it be a for-profit enterprise? You know, we're seeing more and more how devastating that is when you merge profits with patient care. But as you always point out, this should be a utility. These hospitals should be things that are there to serve the public, not serve some financial interest.
Which also goes to, if you look at the trajectory starting back in the mid-late 1980s of the private equity firms, the leveraged buyouts, the Drexel era, they were going after targets that were really, they felt they were undervalued public assets that they would take over, they'd fix them up, they'd sell them back into the stock market, and they hopefully would get the same valuation that the other players in that industry were getting in the public market. So it was early life cycle. It was going after Nabisco. It was going after consumer brands. Essentially, we're very late cycle in this whole industry. They've run out of assets to pilfer. And so the late cycle plays are the ones that historically would have been too hot to touch. And what I mean by that is things that were always accepted as social goods, education, healthcare, things where they're not supposed to run for profit first and foremost. They're supposed to run for public service, public good, public outcomes first and foremost. And the whole world had gotten, and we're late cycle, so that became sort of the big fat home run industry for them. And Washington had become so lazy in thinking about reining these companies in that it was just one step over the line for them rather than, as it would have been 10 years ago, 20 years ago, a bridge too far.
And I was thinking, as you were saying that, also about how the financial crisis 2008, there was a similar sort of setup where you had Fannie and Freddie, also sort of these weird hybrid public-private sort of things, ultimately backstopped by the government, which all the predatory financial industry could sort of plunder, and then knowing it would be bailed out in some way.
Exactly.
Yeah. You mentioned, Gretchen, also you mentioned this report. So in the book you talk about how Representative John Dingell in 1987 and then Senator Bill Frist in 2006 foresaw some of these consequences. There was a report that Representative Dingell commissioned called, with a wonderful title, Leveraged Buyouts and the Pot of Gold, about troubling takeover boom that was transforming corporate America and imperiling workers. And Bill Frist, as you mentioned, in his report that he asks for the Congressional Budget Office, they said, quote, were an influenza pandemic to occur, local healthcare systems would not have a sufficient number of beds or enough staff or supplies to meet the demand. So 1987, 2006, it's not as if nobody was warning of these kinds of problems. I mean, to forget COVID, but even the intersection of COVID and private equity.
Well, and Gretchen, it's probably worth going a little bit into the corporate practice of medicine erosions, because I think that's actually an important piece of this.
Well, there are laws on the states' books in like 32 states that prohibit what's called the corporate practice of medicine. And these were laws from the early 1900s in which they were trying to protect against sort of quack medical practitioners, and they made it clear that you really had to have the profit motive separate from the healthcare industry. So there are laws on the books in 30-something states, and nobody goes after these people for the corporate practice of medicine, even though it is absolutely that they are searching for profits. They are mining these very important industries for profits. And so this is a real example of how the government had a tool in these states to stop this practice and did nothing about it. So you don't just have these people who are grasping and who are extremely, sharp, smart, sharp-elbowed folks, the usual. You have a government standing by and allowing it to happen.
And this is through Republicans and Democrats, quote unquote, more free market and more regulatory oriented. This does not, it's not
one side of the aisle or other, no.
This is the onerous
Money is
regulatory.
fungible, and lobbyists are too.
Yeah. One of the most damning things that you point out in the book is that because, well, for a variety of reasons, but at this point, the returns on these deals are not so good, that they're actually not making the people, and the people who are investing these things are not ordinary people like us as much as they are huge pension funds, insurance funds, sovereign wealth funds, all sorts of things, who are looking for, they'll take big risks, but they want big rewards. It seems like they're not delivering the rewards as much. Why, if private equity isn't as profitable as it is, why are people still investing in it?
This is the $64 trillion question, and it really is a situation where market forces are not working properly. So if you have a pension fund manager or an institutional investor, insurance company, they have an obligation to whomever their customer is, and their duty is to get the best possible return. And they have been plowing money into these practices that are really harming some of the very people that they are supposed to represent and that they are supposed to have a duty to. Plowing money into private equity, even though it has very high costs, is extremely opaque. You don't know what you're buying, really. And you say to yourself, okay, when they were making a lot more money, that was fine. That was great. More power to them. You know, I can understand that. But now the returns are the same as an S&P 500 index fund, which costs 6 basis points versus the, 300 basis points that some of these things. So it's a real mystery why the pension fund managers who have not taken this up. What do you think, Josh?
Yeah, I would also say, you got to remember the origin of the relationship, and it goes to like the problems 15 years ago, 20 years ago, defined pensions, defined benefits of the pension accounting, where they were actually allowed to assume that they were earning a 10% rate of return, even though their performance was actually not providing that. And they were able to do that on an actuarial basis because their obligation was to make sure that they were fully funded when an individual retires. And so theoretically, they'd have to true up sometime down the road. And so we had this constant underfunding of pensions. Okay, and so private equity was able to step into the void there and argue, we're going to fill that hole. Now we're in a place where those holes are just as large as they were because the performance isn't good. And now we're actually watching these same firms start to say, hold on, we're going to actually buy the insurance companies. We're going to buy the pension liabilities, and we're going to load them up with even riskier short-term paper in hopes of being able to earn that hurdle rate back in the future before these people retire, risking the whole system at this point. And that's sort of unfortunately where we're heading. And to your point, the pension funds are, sort of hand in glove here.
It's the degenerate gambler going back to the casino one more time because he's sure he's going to hit it this time.
Yeah,
Right.
Yeah, no, exactly.
And you have the case early on where one of the first cases you have of an insurance company which is purchased by private equity and then basically, if not defaults, then underfunds and gives only a few pennies on the dollar to its clients, which was, I didn't understand how that was even legally possible.
Also with the help of the government.
Yeah. The book's not only an account of what's happened for the last 30 years, it's really kind of a cry for action. One of the things that's, in addition to the great reporting and the great characters and the thinking behind this, it's really a cri de guerre. It's sort of saying, look, you cannot read this book and not be angry, or you should be angry. Do you see any reason for hope that things are changing? You try to give us, I think, some reasons for optimism. We have 6 minutes left. I figure we can get some optimism in here.
So it depends on, my gut answer would be depends on how angry the readers get.
Okay.
Yeah, so get angry out there, guys.
Right. Get your pitchforks out.
Yeah. I think that there are some glimmers of hope. There are some straws in the wind, but these are extremely wealthy, extremely powerful people. Washington is very happy to see their money and very happy to either act on their behalfs or do nothing on their behalfs, depending on how that benefits them. So I'm very disturbed that that is continuing to be the way they do business, and they do have a lot of sway in Washington. So that is a problem that we will continue to face. We are, I believe, having people start to question this business model from the standpoint of it not being a sustainable business model, meaning that when you have a business model where people get laid off, immense numbers of people get laid off, where people die in your nursing homes, where you have a situation, where you ravage a pension, where the costs are far higher for the services or products you're providing. Those are not sustainable business models. And so we really just need to focus on the fact that this is not a sustainable business model. It enriches a very small number of people. The circle of pain around those people is 360 degrees, and that's just not where we should be.
Yeah, and I would say, you know, we are seeing, and it's funny because it's coming from the far left and the far right politically, we are seeing, especially on the Senate side, glimmers that you're seeing, you know, a Marco Rubio and an Elizabeth Warren talking about working together because this is now about workers and Main Street and families. And so that's one glimmer of hope. I think realistically, the glimmer of hope is you're going to end up seeing at some point a financial downturn which uncovers so many of the skeletons here on the mark-to-market accounting, on the failures of their portfolios, on their inability to sell a deal from one player to another player at a profit. So we talked about how they were able to sort of mark to model and have these sort of club deals, it felt like, where I could sell something to you with a wink and a nod and you're going to pay me a premium. And if we have an economic downturn, it's going to be harder to do that. And I think those are the types of things that usually uncover this more than, unfortunately, regulatory legislative action.
Well, I mean, to undercut my own hope for optimism, I mean, a week or two ago, Silicon Valley Bank was, for all intents and purposes, bailed out. You know, now the $250,000 cap on insurable deposits is effectively off. And you know, anyone who's going to get their money back in terms of what they've done. How do we know that if there is this economic downturn and these things are marked down to where they actually should be, that there won't be more bailouts for exactly these companies? Well,
so first of all, that was Dodd-Frank and relates specifically to banking law, and these companies don't operate under banking law. So they'd have to make a very strong argument for Congress to act to rope them into a bailout, unlike Silicon Valley. But it's interesting you say that, because when you start looking at who the depositors that were bailed out, we keep hearing, well, Silicon Valley, we bailed out depositors. But those depositors were, in many cases, precisely these same firms.
Yeah.
Private equity, venture capital firms, very wealthy entities. Yeah, so, you know, I think it would be a tough response, I think, to bail out a private equity firm. I think that there is an understanding about their tactics and that they are sort of the, you know, me first equivalent here in Wall Street. But so I think it would be difficult to bail them out. However, they are very integrated into our financial system. And so I could easily see them making the argument that the whole thing could collapse if you don't bail us out.
Well, or more, I think, as importantly, they'd come at it from the other side as well, which is the vast number of employees that they ultimately employ.
That's right.
Right? And by the way, they own, I was looking through one of the portfolios, they own a lot of our defense companies. They own a lot of our high-tech, sensitive tech companies, right? So there are arguments that can be made about why they are, you can't say systemically important, but important.
Right. I mean, the statistic, the stunning one you have is, what is it, a third of the emergency rooms?
No, well, if you add in all the private equity firms, the two largest firms, which is Blackstone owned and KKR owned, run more than 30% of the nation's emergency departments.
I mean, could you say come to the government and say, well, okay, we can go under, but you know that as a consequence.
Yeah, but in capitalism, doesn't that mean that if we actually are going to live as we say we are going to live, that we would just transfer that to stronger hands?
Right. Well, that's the idea, I guess.
So I think the answer is, Bob, to educate and get people aware of who these companies are, what they own. They're very good at hiding behind the curtain. They don't tell you that you're going to an emergency department that's run by a private equity company. They're really good at stealth. And so they've taken over so much of the economy.
So much so that Gretchen had started, so the corporate practice of medicine essentially says that the health business, the medical practice, has to be owned by a doctor. It can't be owned by a corporation. It has to be owned by a doctor because the focus should be on patient outcomes, not on profits, as Gretchen pointed out. You had found, starting rolling up, one doctor had
300 different companies that were
Across-
all owned by the private equity firm.
But his name was on.
his name was on them,
was-
and it was in some ridiculous number of states.
Yeah,
as
no,
well.
he was in like Massachusetts, Texas, South Carolina, Arizona. The guy could not have been in all those places at once. And so you had this situation. So they find a way around these.
No wonder the wait for a doctor is so long. He's got
Yeah.
he's got all these different firms to take care of.
Right.
Listen, Gretchen Morgenson and Joshua Rosner, thank you so much for this, and thank you for writing such a terrific book. And everyone should read this and get angry.
Thank you.